Yeah, I'm losing my edge.
Today we are trading bonds with ETFs, Michael, and this is going to be an interesting one. I asked you for a couple of topics that you were interested in. Yesterday, you came up with this one, and I think it's a super relevant one. We've got our new S10Y product that is on a fee holiday. No, it's not on vacation. That just means that the small exchange is waiving all of its transaction fees for the month of January. So you can get in there and try that product out with no exchange transaction fees, no market data fees on the product. All of that stuff aside, all great stuff from the small exchange. Michael, why did you want to talk about trading bonds in light of your past experiences before S10Y came to market 2 months ago? What was the problem or the disadvantage of trading bonds with ETFs from your point of view? Why do you want to talk about this?
I think this is a super important topic because a lot of new traders are interested, I think, in interest rates. You hear about them everywhere. They're always in the news, whether it's CNBC, Wall Street Journal, even like your local news is probably talking about interest rates in some light or another. Yet they're so difficult to trade. And I don't mean that in like, it's difficult to determine direction or you don't know what's going to happen. There's all kinds of guidance from people like the Fed and all these macroeconomists, but you go to the market to trade and it's like, I'm going to pick up a ZB future that can move $1,000 a day in some weird fractionalized quoting convention that I have no idea what it means. Or I get pushed into this realm of there's a small suite of treasury ETFs, but they really don't trade. They don't track kind of what you're looking for. So you're stuck in this rock and hard place. And I want to bring to light the fact that S10Y exists. And it's really filling the niche here and allowing many more people to participate in one of the largest markets in the world.
No, you're totally right. And I here is the small yield futures, the latest in interest rate products. And yeah, they've got that $0 exchange transaction fee for the rest of January. And you can see here what Michael is talking about. Like, this is the journey, the route that interest rates have taken over the last 12 months. And you can see it's just a matter of multiplying that percentage by 10. Right down here, when it was at $8, that was just 0.8%. Here at $10, that's 1 percentage point. It's very simple. And that goes a long way because, Michael, you're totally right that, whether it's the confusing futures or the clunky ETFs that we're talking about here today specifically, whenever a trader or an investor or whatever you're doing, a lot of people add bonds for risk management purposes. If there's an ounce of confusion and it's like, I think I'm supposed to buy this thing if I want to be, short interest rates, or I think I'm supposed to sell it, people go away from it. And I totally understand. It's like, I'm not going to put, potentially hundreds or thousands of dollars with those big futures towards something I'm confused about. So it's an awful starting place. We did a lot of work to reduce that down to one simple price here. And you can see that 1%, if you're reading the Wall Street Journal, Financial Times, anywhere else, anything that's quoted an interest rate here for the 10-year, it's going to be reflected right there in that futures price. And it's going to only cost you $180 given by the initial margin from the small exchange. I mean, you'd be hard pressed to find any product out there in the market, be it, a couple of shares of stock or definitely not any traditional futures, that are $180 to try out with zero exchange transaction fees.
Yeah, and I would even add to that some of the brokers currently offering smalls are even waiving their commission fee. So now there's pretty much no cost. You got to pay 2 cents to the regulator, the NFA, but that's pretty much unavoidable. It's a cost of doing business. But yeah, it's literally never been cheaper to try these futures. And this is the story that we're so familiar with, right? If you looked at a price of ZN and you tried to relate that to the news stories you were reading, it's two different worlds. They don't match in any way. Yeah. So this is, I think, what most people are comfortable with. You wouldn't want to trade a product that you don't quite understand. I think that's taking unnecessary risk. So here you have it, the story that you know, and a quoting convention that's very familiar and easy to adopt.
So today, let's dig a little bit deeper. Make people, I know that this stinks, Friday afternoon. I don't want to make you have to flex your brain muscles too much maybe time to flex your drinking muscles or your lung capacity if that's what you're into. Just give us a little bit more time here because I want to show something even further, take even a deeper look under the hood here, looking at TBT and TLT, both ETFs that I have loved to trade in the past because they are the best. I'm going to go out there and say it. We obviously have no ties to anybody trading those. Those are the best treasury tangent ETFs that you could trade, TBT and TLT. Now, TBT is weird because it's an inverse treasury price ETF, which just at the end of the day is like, oh, it moves like a yield. So that's how complex this system already is TBT is the inverse of TLT, but then isn't that just the yield because the inverse of the price is it's really confusing. I don't want to go too deep on that. I just want to look at, Michael, the movement in these products because this is a specific asset class where futures margining is essential because interest rates are so low volatility. Same with foreign exchange markets, like we've talked about in the past, that you've got TLT moving $128 per day, and you go, oh, that's a good amount. That's a nice day, around $100. That's what the small exchange, we try to make our products so that they move around $100. I have to put up almost $7,600, Michael, for $100 in movement. TBT is a little bit better with that potential return on the margin there, but these are all three products that move around, $50 to $100 here, and S10Y. The margin requirement there is under $200. The rest of them, $1,000, $7,000. Absolutely insane.
Yeah, it's way too much capital. I mean, if you're working with a $5,000 account, this becomes just completely impractical, not useful in any way. Even I would say like a $25,000 account, which is an average size. It's tough to get exposure to interest rates with TLT. I mean, I just did the quick potential return on capital calculations here. So you take that potential move, right? That $40 divided by 180, the cost to trade, you're looking at around 20% in the S10Y futures. Oh, man, I'm jumping the gun here. I'm doing the math for you.
You're all good. Keep rolling.
It's already done. I mean, look at the discrepancies here. Potential return on capital with the futures, 22%. Potential return on capital with the TLT ETF, 1.7%. Capital is your finite resource. It's how you're going to take advantage most in markets, your most useful tool. You want to get the best bang for your buck that you can. And I think futures are a great way to do that.
Yeah, and this is a frustration I know people feel with options as well. Like you got a Fed event coming up and you're looking at selling strangles or straddles, or you're buying strangles, straddles, iron condors, whatever you're doing there. And the buying power for short options in those trades, Michael, is astronomical relative to collecting like 60 cents, 70 cents. And it's like, I'm putting up $3,000 to try to make, 20, 30, 40 bucks off of this. It's ridiculous. And that comes down to the fact that ETFs, they margin you 50% for buying or selling those shares. And then the options are usually around 20, 25%. And that's as good as it gets. And it's not good enough for a slow market like interest rates. And that's not to say that you and I love interest rates. Just because they're slow doesn't mean that you cross them off your board, because they're very diversified. It's a great trade relative to equities and foreign exchange and everything else. And what's even better on that note of diversification, you and I always conclude the efficiency conversation with this. Like, we don't want to drop down these margin levels. For, like I said, all of these essentially move a pretty similar amount. TLT moving a little bit more just because it's a higher priced ETF. I don't want the cheapest one here, Michael, so that I can do, now I can do almost, I can do 10 of these S10Ys and I still have less margin than TLT. That's what I'm going to do. No, it's a matter of like, oh, I got a cheaper option here so that I can diversify everywhere else. Like you said, it's that finite resource of your buying power, of your capital, and using it efficiently allows you to go into other asset classes like the growing interest in crypto and everything else. It's not a matter of efficiency for the sake of levering up and adding risk. It's efficiency so that you can add bonds to the equation and then continue to diversify everywhere else without hampering all those other asset classes.